should you T-bill and chill? The pros and cons of taking refuge in cash now that yields are hovering above 5%. And this is on the short end of the yield curve because remember, the yield curve is still inverted. And this has historically always been a very good indicator that a recession is on the horizon at some point.
The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. So lots of talk about bonds. John, you and I talk frequently about just common questions that we receive. Mm-hmm. And I think you just alluded to it a bit ago that a lot of people have been having a lot of questions about bonds. And what's the strategy around it? What are the best things to do? Where do you put funds? And, we've talked about kind of the longevity or what's the objective of funds. But there's an article on Morningstar that says, should you T-bill and chill? The pros and cons of taking refuge in cash now that yields are hovering above 5%. And this is on the short end of the yield curve because remember, the yield curve is still inverted. And this has historically always been a very good indicator that a recession is on the horizon at some point. On average, I think it's around 15 months from when the yield curve inverts. But then it's really about when it uninverts is when it suggests that there's struggles, right? So what are your thoughts and takeaways on this?
Well, I'll tell you, for folks out there that are taking advantage of these higher yields on the short end of the yield curve, because as Danny mentioned, the yield curve is inverted because, as everybody knows, the Fed has been so aggressive with raising short-term interest rates, at least up to this point. Over the last 12 months, or the 12 months, through October of this year, and the previous 12 months, over $900 billion of assets have moved into, money market funds that are paying, give or take right now about 5%, right? And really, earlier this year, the yield on the 3-month T-bill, it was, nearly 5.5%, and that's the highest level since December of 2000. So it's easy to get attracted to this, and there's no issue with, hey, if you have some emergency funds or money set off to the side that really isn't for your longer term, let's say the longer term growth portion of your portfolio, hey, utilize these yields on the short end of the yield curve and maximize your cash there. But does it make sense to put all your money there? Is that the argument where it feels great to be earning, let's say on a 5.3, 5.25% right now, but will rates stay this high forever? Right?
Yeah, I think the bigger risk you face right here is a reinvestment risk.
Yeah.
What do you face when yields inevitably come down? And so a lot of people who do have the majority of their funds in, say, T-bills or money market, some maybe for other reasons, right? I've talked to a lot of people and visited with folks that say, hey, I've got money in the bank. It is not earning anything at XYZ bank or, most of the major institutions, the really large banks, they're not paying you. Mm-mm. I went through and looked a while back. It's like 0.01. And if you have a relationship with us with X amount of money, we'll pay you, we'll double that to 0.02. Wow. Thanks, guys.
Hey, from a percentage standpoint, just the increase, it sounds great. But when you look at it, you're like, well, hold on a second. Yeah.
Well, so you start doing the math and you say, well, if I had $100,000 at 0.02 versus you had $100,000 at 5, right?
Yeah. Mm-hmm.
You're talking about $5,000. So you have one that's not even going to send you a 1099. And what they're banking on is that you and I are lazy and that we're not going to move our funds. And they don't make it easy maybe to go link it up online. And so you actually have to go walk into the bank, go get a check, deposit it somewhere else. There's a number of reasons, but they're banking that we just won't do it. And that safety and the convenience of using them is so great that they don't feel like they have to. And they've been okay for the most part. But there are places that want your money that will pay you to store it. So we've had a lot of people who've set up just brokerage accounts, on their own, and they go say, hey, I'm going to leave it in money market. I'm going to go buy cash. These may be funds that I need for taxes. They may be funds that I need for just emergency savings. But get more bang for your buck. That's what this is all about. So I fear that reinvestment risk at some point because, if you do see inflation come down, if we do see the Fed aggressively cut rates here in the future, where do you go then? Mm-hmm. And then you have the other, I think there's two sides to this coin, John, in the sense that you have people that have money that's been in cash They're not earning anything. They want to get a little bit more for it. And then you have the other camp who says, hey, market's going to crash. I'm going to put everything into this and we're going to wait it out. And then at some point we'll buy again. If you can do it, great. Now, you may have to wait because a lot of times we think the market will do one thing and then what happens? Additional stimulus, something comes up, the market dynamics shift. We see positive things, occur. That's not out of the question. I know the negative narrative is much easier to be in that camp. But I would still, with all of the things that are out there, I still think that we're cautiously optimistic.
I think so too. And so you make a great point. So let's say you're in the camp right now where you're saying, okay, I'm just going to put all my money in my T-bills and I'm going to chill. I like that, T-bill and chill. It's got a good name to it. Feels good, right? So let's say the markets do correct. Let's say equities pull down. Let's say we get into a more volatile market next year. Nobody knows what the future holds, right? I mean, nobody knows what this market's going to do. But let's just say that happens. At that time, if that happens, and let's say you have some T-bills that are maturing, you got some cash coming back into your account, will you have the discipline? And emotionally, would you be able to nibble?
That's a great question.
At equities at that point? Because still to this day, Danny, how many people do we talk to where, well, you know what, John, back in the great financial crisis in 2008, I went all to cash. And I waited. I was going to get back in.
They're still in cash.
I was going to get back in. I was going to wait for that market to give me the opportunity to get back in. And it's 2023. And they haven't been back in since.
Well,
right?
The problem with that is that...
And it's hard.
They haven't been getting paid either.
That's true.
All those years because cash has paid absolutely nothing. And if you think that we're going to get back to where interest rates go down or the Fed's going to have to come out and be more aggressive and inflation's coming down and growth prospects don't look as great, well, then you need to figure something else out. So do you just sit in T-bills or do you start going a little bit longer on the yield curve?
Mm-hmm.
And, the other thought is that, okay, well, so we'll say we do get into this time where, markets are volatile. We get into a bear market. Something happens. Rates at that point come down aggressively. And then what happens? Do we see the Fed? Do we see more monetary policy, more fiscal policy, more stimulus dollars, more inflationary pressure because of those things? I don't think that's out of the question. So at that point, you're going to have to be nimble and your strategy will have to change once again. And so, instead of just T-bills, John, do you start to look at intermediate? Do you look at longer term? Do you own a bit of stocks? Maybe you take the contrarian view and go buy some defensive stocks. Those have been out of favor. Those have underperformed. But do you have a little bit of all of that? So, some of it, Wayne Gretzky and Lance has used this before. He says, the key to it is to skate where the puck is going, not to where it's been. And I think that's a really important kind of thing to think about when we're talking about investing was, okay, where do we need to be next? How can we prepare for what may or may not occur, right? You've got to think about probabilities and percentages.
I think so too. And as investors, all of us, myself included, it is really easy to look in the rearview mirror and look back and say, well, you know what, Danny, if I just would have kept my money in my money market this year, I would have been better off. Or if I would have just had all my money in 3-month T-bills this year, I would have been better off. Looking back and seeing what's already happened to say, oh, if I just would have done this, that's, unfortunately, the markets they just don't give us that luxury.
I wish I was all in tech. You kidding?
Man, if I would have put all my money in the Magnificent Seven this year, no stress, right? But if I was your advisor and came to you earlier this year and said, okay, Danny, here's your financial plan. This is what you and Michelle are trying to accomplish. I think we're going to put all your money into these 6 or 7 names. You would have looked at me and said, John, you're crazy.
See ya.
Right?
Yeah.
Now, if I would have done that, it worked out, you're going to think I'm brilliant, right?
Correct.
But what if I got it wrong? That could be a disaster.
Or what if you hold it and then it turns again, right? Nobody wanted to touch those last year. And now, those were the most favored stocks. So I think that's a great point, John, that you can't put all your eggs in one basket. And we don't mean, like you have to have them all in. Some people take that so literal. They're like, well, I'm going to have an investment account here, 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 here. at every different firm. Like, wow, that's unmanageable almost sometimes.
Yeah.
And it's a pain in the rear. But, do you start to go out longer on the yield curve? And so we own long-term bonds. And a question we get frequently is, okay, guys, we're going to hold this until 2043? Like,
Yeah.
No, we're not going to hold something for 20 years. I mean, that's not the intent. The intent would be is that, if things play out the way that we think they likely will, you're going to have some significant upside here at some point. Obviously we've been a little bit early to the game in that part, but I still think you see significant appreciation, and then you turn around and you have the ability to buy, if that happens. So, you start thinking about it. This soft landing narrative is going to be extremely difficult. They're trying to thread a needle here. And maybe they get it. Maybe this is the first time in over 20 some odd years, 25, 26 years, that we actually get a soft landing. I don't know if that's the case or not. But I think to get to where they want, you're likely going to see some pain. So do you therefore go out in longer term intermediate treasuries? Do you still have some T-bills to give you flexibility? Do you kind of ladder these bonds out, ladder CDs out? We talked about looking at objectives, but also looking at, when do you need these funds? Mm-hmm. What is the long-term goal? And are you one of those people who has the intestinal fortitude to go out and say, okay, we're going to buy when things are bad. Things are much cheaper. And I think that's the key. I mean, you mentioned that earlier, how many people that have been completely out of the market for 15 years.
Yeah.
And for all those years, really not earning much, if anything.
Yeah, that was the challenge. You really weren't earning anything on your cash. I mean, 2 years ago, these money markets that we're talking about right now, they weren't paying even a quarter of a point, right?
Yep.
So at least you can use that to your advantage now. Great point, Danny.
Life is an illusion. Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. It's rock and roll. It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.